Dean Lyons, all of you ladies and gentlemen, distinguished faculty members, family, friends, and guests, and especially to you, the graduates. I'm honored to be speaking today to such a distinguished and lucky group of graduates. Distinguished in that I think this is the best financial engineering program in the nation, and lucky in that you're just at the start of an exciting career at a time when big data, deep learning, changes in financial regulation, and all of these other things are going to affect the financial worlds for the next decades. I give my congratulations to all of you for having completed the program, the determination to get through what I clearly hear has not been the easiest of programs. This is not a cakewalk. This is hard work, and you guys have done it, and you deserve a lot of congratulations for that. Let me give you a little bit of my own history. I grew up in New York City. I went to the Bronx High School of Science and W.C. Bryan High School, and found that I could graduate early, and as Linda pointed out, I did that. I figured out a college I could apply to. It was already March, so I didn't have a lot of choice, and I went to City College of New York, a great public institution. It was also true that City in 1962, when I entered, got its first desktop computer. Now, in those days, a desktop computer was actually a desk. It was a whole desk-sized computer. It's called Royal McBee, LGP30. Royal McBee is a company long since out of business, and you used punch paper tapes. And the difficulty was that nobody knew how to program it. And I noticed on the wall a poster. Now, before Facebook and Twitter, they had these things. They would actually put them on the wall, and you could read them. And it said that you could study programming. There were 3 courses being given, three lectures being given, but they conflicted with physics. So I had to go ask my physics professor for a leave, and could I take these 3 classes and miss the 3 classes? Because you couldn't cut classes in those days. It was very different. You couldn't look them up on the web if they didn't work. Well, he did allow me to do it, and that set me on a course that has completely sort of changed and focused my life for the last 55 years. The following year, City got a transistorized computer. It was called the 7040, the IBM. We wrote a compiler for a language called MAD, which stood for the Michigan Algorithmic Decoder, and my claim to fame was that I was able to print a picture of Alfred E. Newman saying, "Want me worry," at the front of every job as the output came out. Then I found out I could graduate City College early if I took 12 summer credits. And so I had to figure out where to take 12 summer credits, and you probably don't realize this, Linda, but they were here at Berkeley. So I actually am a student who's studied at Berkeley. I took 12 summer credits in the summer of '64, quantum theory, chemical physics, computational math, and linear algebra. And learned how to walk up and down the hills. I actually lived at International House. I walked by there this morning. It was kind of nostalgic to see it. And I saw the start of the free speech movement. You talk about those Berkeley values. Well, that Sproul Hall and all that, I was here right there. And I've been coming to California ever since, even though the very first afternoon I arrived here, there was an earthquake, a 4.1 earthquake. So I guess I got over it. Perhaps the most important interaction in my young life, other than meeting my amazing wife of almost 50 years, was with a scientist who was mentoring at the computer center. His name was Richard Hamming. He invented something called Hamming codes, the error-correcting codes that are used pretty much in all the computers. So one evening, it's March of 1965, and he said, "Howard, what are you doing next year?" And I said very proudly, "Well, I've just gotten a fellowship to MIT in physics." And he looked at me and he said, "You're a smart kid, but Nobel Prizes are really hard. And I don't know." He says, "I got one word for you." Just like in The Graduate, he kind of leaned over and he said, "One word, computers." He said, "I know you like computers." He said, "It's the future." And I am so glad that I listened to him. He was able to help me get into the Cornell Operations Research Program, and mentioned in passing that they were just starting in September '65 the computer science department. So it was the first year of the computer science department. So I took operations research, I took computer science, and I ended up with a PhD in operations research, with a minor in computer science and a minor in applied statistics, what would be today the perfect profile for Renaissance technologies. No finance, no knowledge of the markets, just knowledge of how to deal with lots of large numbers and how to deal with computing. Now, after receiving my PhD, I decided to stay in the academic world, again, just missing, in this case, something with Berkeley. Shell Development Corporation has a big research center in Emeryville, and they made me an offer, and they wanted me to come as a researcher. And I said, "Okay, what's the salary going to be?" And they said, talk to HR. So I went to HR, and HR said, our salary scale only goes down to 25 years of age for PhDs, but I can extrapolate it down 3 years and find out what you could be making. And I looked at her and I said, down? I think I get a premium, right? She said, no, we want everyone at the same age to be making the same amount of money. So I realized that was not for me, at least at the time, and decided to teach. And I went and took up Cornell's offer to be an assistant professor of both computer science and OR. I was teaching simulation, I was teaching databases. I wrote an article in Communications ACM about very large databases at the time. I was the first editor of the database journal. And I wrote about a ton of data. Now, a ton of data in those days was the amount of data that would fit on a ton, 2,000 pounds, of 6,200 BPI tapes. And that turns out to be about 10 to the 12th bits. That's a ton of data today. One USB key, 32,000 times lighter, at least, maybe even more than, maybe 100,000 times lighter for the same amount of data. The amount of change that we have seen in the field of computing and the mathematics that goes along with it and its application to finance has been just more than anyone could ever have realized. And one of my themes for you today is, in fact, a theme that Dean Lyons talked about. He said, students always, I call it always be learning. Because the one thing that is certain, and particularly certain in the financial markets, is change. Now, also on the Cornell faculty with me, in the OR's faculty, was Howard Taylor, who published one of the first papers on options pricing. And I read the paper and looked at it, and I said, these option things are interesting. And in those days, if you wanted to buy options, you looked in the New York Times and the Wall Street Journal, and they had little ads, and they said, you can buy a put option on 100 shares or a call option on 100 shares for June 30th for $200. Call Thomas Haben Botts. That was the name of the firm that had all these old option things. And you called them up and you bought an option. And there was no exchange. There was no minute-by-minute trading. It was printed in the paper every day. And the pricing was so far off that I was able, with a very small amount of money as a very young assistant professor, to make a couple of trades and buy ourselves an $800 color TV. I thought that was the greatest thing. The financial world, I was kind of hooked. They always say when you're gambling, the worst thing that can happen is when you win the first time, because then you think you can always do it. Unfortunately, you learn we can't. My thesis advisors were consultants to the Rand Corporation, and they got me out and working out at Rand on a few interesting things. And then I spent another year out as a professor at Caltech. But my wife and I were really Easterners, and we wanted to be back in the East Coast. So we went back to Penn, where I got this joint appointment at computer science and the Wharton School, both. Because my focus had been on applying computers and computer science and OR to decision-making for businesses. And part of that was applying it for business and government. So DARPA and ONR gave me the funding to have Machine 50 on the net. So if you can think about the information as an information superhighway, we were hacking it out of the brush. I now have 45 years of email backed up, and I have received the first spam ever sent. It was sent in 1974 by someone at Digital Equipment Corporation. In 1977, Peter Wiener, who was at Rand Corporation, asked me to join a company he was founding, which was a company that got the first license for Unix. Up until then, Unix was only given to universities by a very complicated trade secret license. And Peter said, gee, we could build business systems with this, and AT&T gave us the license. And I spent the summer working with him, and I said, how are you going to fund this? He said, well, I have this friend who's a professor at Stony Brook, and he said he can give me the money to fund it. He's made some money from some investments he had in Latin America. And his name was Jim Simons. And so that's when I met Jim Simons. And Eugene Derman, who gave the commencement address here a few years ago, pointed out that if you want to really be a genius, be early in a new field when nothing is known and everything you find out is new. And being early with Jim Simons in the quant field was a way to be a genius. I don't know that I am one, but I do know I was lucky. And as my parents always taught me, it's always better to be lucky than smart. So at that time, there wasn't much quantitative modeling going on, very little. Carnegie Mellon had done some rule-based systems for trying to model what bank investment officers did. There were a few people looking at averages, and you had the quote, technical analyses of Elliott waves and, moving averages above and beyond, crossing, but very, very simple things, not real theoretical statistical analysis being done on things. So in 1980, I was still at Wharton, and Jim said, well, we're making some money now. Why don't we try some tech investing? So he gave me a pool of money to invest in tech stocks, which I did. Then in 1982, he said, I now have too much money for the current quant stuff I'm doing. So from 78 to 81, 82, Jim and Dr. Leonard Baum, who was one of the nation's great code breakers, who had joined Jim in Stony Brook, took $1 million and turned it into 70 million. So I think it went from maybe 1 million to 2 million to 6 million to 48 million to 70 million. And when it got to 70 million, the models they had didn't work. They had reached capacity of those models. One of the lessons that I keep learning, and I keep teaching, but people have to learn it again, is that there's a real capacity to any quant system. And if you try to push the system beyond that capacity, the returns go to hell, and that happens much faster than you think when you hit that capacity point in the system. So he asked me to take a leave of absence from Penn, and we started Renaissance Technologies with $70 million, and we put half of it in venture and half of it in quant. And I focused on the venture, although I gave advice to them on the quant, and Jim focused on the quant, and he gave advice on the venture. We did a number of them out here. One of the companies was a encryption company called Silink at the time, which basically bought the RSA, not the RSA, the Diffie-Hellman patents, and encrypted the SWIFT networks. Now, that was a lot of fun. Our venture capital inside of Renaissance had a 25% IRR after 7 years. We were a top decile venture fund. But as Jim pointed out in June of '89, we now have a 38% IRR with the quant side. And that's, of course, after fees, and Renaissance's fees are quite high. But when you're giving investors 38%, they pretty much don't question the fees. I mean, they can question them, and you say that very simply, yes, that you're right, the fees are too high. Where do we send your money back to? And then they all say, no, that's not what I meant. So I went off on my own to do investing, what we would typically call angel investing today, or super angel investing. And Jim, with the help of another Berkeley professor, Elwin Berlekamp, who's still out here, and a bunch of other people, went on to get the Medallion Fund up to where it has become, and Renaissance to become the much greater organization it is today. Brought in Peter Brown and Bob Mercer to help run it from the speech technology groups at IBM. Those are guys who really understood hidden Markov models, and really focused on building a capacity that to this day, which is several hundred researchers, is kind of unparalleled. I think the closest that anyone has got is 2 Sigma, which is an amazing organization as well. But it is clear that Renaissance runs at a level of excellence and tries to. Now, the only problem with Renaissance is they have 2 groups. One group that does all the research, and they don't want those people to know anything about the markets. They want it to be purely statistical and mathematically driven. Okay. Then there's the trading group that has to execute the orders that those other things come up with, and they can know a lot about the markets because getting orders to work right is always an important thing. So I went on to start Idealab with Bill Gross in 1996. Actually, it had its 21st anniversary on Pi Day 3 days ago. We invented paid search there, Overture, which ended up costing Google $600 million in the patent rights. And a lot of other companies, one of which has one of the URLs which went into disuse, it seems to be available, called research.com. If anyone, I noticed it was up for sale recently. So sometime in the late 90s, another scientist I had met, a fellow named Sasha McDowell, who was a professor of physics at Princeton, found that he also liked the market. So we started a company called MagicWorks at the time. Today it's called McDowell Research. And started doing high-speed trading. And the technology, which we later spun off as a company called Algo Technologies, was able to do matching much faster than anyone else. Now, you've read Flash Boys, so this was in sort of 99 to 2003, long before the fiber optic cables were being pulled from, and the microwave links between Chicago and New York and so on. And we actually relied on computers and software to be much faster. In fact, the New York Stock Exchange about 5 years ago bought Algo Technologies because Algo's matching engine could match orders at high speeds in sort of 10 to 12 microseconds when their systems were running at 2 milliseconds. And the markets were giving them lots of flack for that. In 2004, an entrepreneur I had funded twice, Josh Koppelman, in a company called Infonautics first and then a company called Half.com, we started talking about doing seed stage venture investing in a much different way. And he wanted to learn about venture capital. I wanted to learn about the new worlds, because, again, always be learning. Students always is a key feature of my life. And we started first round capital. And we noticed that you could start a company for a few $100,000. So we started Infonautics in '92. It cost $5 million to get the first product. We had to buy Sun servers and Oracle licenses. We started Half in '99. It cost $2 million. We started another company in 2003. It only cost $700,000. And by 2005, and of course today with Amazon Web Services, where you don't have to buy any hardware, you use open source, so you buy almost no software for quite a while. You can start companies for small thousands of dollars. So today at first round, we have $900 million under management. Our newest fund is just about to start, with offices in New York, San Francisco, and Pennsylvania. 6 investing partners, and about 25 people just dedicated to helping the companies grow. One of the things we like to invest in is fintech. And one of the great things about a program like this is it's producing a lot of people who are very knowledgeable in lots of aspects of fintech, not just in how to price derivatives. So, for example, we were the lead investors in OnDeck Capital, one of the first peer-to-peer lending for business. And what OnDeck realized is that modeling default rates, and the banks model default rates all the time, when you get data from the companies basically 45 days after the end of the period that they're reporting on, isn't particularly good. What we do at OnDeck is we get attached to your bank account. We see your receipts every day. We take payments on the loans every day. We build statistical models that tell us when things are going wrong. So we have a much quicker feedback loop. And that's part of what's happening with the markets. Much faster feedback loop on performance and much broader information to make decisions. So we're investors in Upstart and Earnest and Vouch, and these are all companies that are investing in people like you, what we would call future prime borrowers. If you go out to get a loan tomorrow, your FICO score is probably 650 because you're a thin file, you don't have much information. But if we say, gee, this is a person who's got a $250,000 a year job at a top hedge fund or a top investment bank, and they've graduated with a Berkeley MFE degree, gee, we should think of them as a 750 credit score and treat them that way, and we can get their business for life. So we've done a lot of that. Now we get to the sort of more classic quant. So about 8 years ago, I invested in Predict Wall Street. And Predict Wall Street uses the wisdom of crowds, and it obtains that through very simple internet surveys. If you go on the Ameritrade websites, it'll pop a little widget up and says, do you think Apple's going up or down today? Or do you think GE is going up or down today? And you respond. And they aggregate millions of these predictions to create signals. Now, they show the user, part of what they do is to show you the percentage of people who think it's going up and down. But in fact, the real signaling comes from knowing that, gee, Howard Morgan has just predicted that Apple's going up, and we know it's Howard Morgan or somebody, we don't know his name, but we know that ID because of the cookie or because of the IP address. And that IP address is got a 90% positive correlation with Apple going up or down. On the other hand, we just looked at Linda Kreitzman's prediction that Apple's going down, and she's got an 80% -1 correlation with. So we can weight all of that stuff together and come up with really good signals. And that turns out to be useful. And so not only are they licensing that data and signals to a number of big hedge funds, they also have their own hedge fund that we're doing. But the world keeps moving. So I learned about 4 or 5 years ago about the blockchain and Bitcoin. And we started trying to figure out what could you use blockchain, what could you use Bitcoin for. So obviously one of the things is anonymous payment. There are lots of other useful things for the blockchain in terms of contracts and so on. So when we met with Richard Crabe, who started Numerai, we found some really interesting use. So Richard's idea was to try to get the wisdom of crowds for black boxes. So right now, he had built quant models, by the way, of South African markets. He's a South African, and of the German markets. And he said, what if we start a contest? And we'll give people data to predict on, and whoever gets the best predictions will win a prize. Well, the prize turns out to be $10,000 in Bitcoin. So even if you're working for Renaissance and want to do this on the side, nobody has to know that it's you who's won. How do we give you data to predict with? Well, if we just sent you the Bloomberg data or the data from the exchanges, they would charge us each time we sent out that data. Their data licensing rights are pretty strict. So Richard said, if I can use homomorphic encryption, an encryption technology that preserves the ability to operate numerically through the encryption. So all the numerical results and all those trends are preserved, even though there's an encryption. Then I can send out data, because the data has nothing to do with the actual stocks, with actual stock data. But I'll get people to do the predictions, and then I can back that prediction methodology up to real data. So that's what they do. They send out data, and you can go on the Numerai site and download their data, and you build a black box, and you send back in your predictions. And the best predictor each month gets $10,000 in Bitcoin. And Numerai builds a meta model, and it says, gee, I've got this great black box, and right, by the way, initially Richard's model won for the first few weeks, and then slowly but surely, the last few weeks, the model that's been winning is from Bangalore. There's about 250 to 350 entries now each week. And people all over the world are sending in predictions, and they're building different boxes. But it may turn out that my black box turns out to be really good at predicting the industrial sector stocks, but terrible at everything else. And someone else's black box is great at predicting tech stocks, and you can create a meta model that then gives you a much better view of the whole world. Now, I do believe that the future of quant and the sweet spot for most quant funds is in the 100 million to a billion range, because you stay under the radar. One of the founders of 2 Sigma, John OnDeck, said to me one day, he said, I hate people like you because you're trading these small funds with 10 to 100 million. You look like retail traffic to us. We can't tell that it's another model. And so we can't game against you, which we try to do. So for me, that's a great thing. And that's why we've invested in Domeyard, which is a Boston company in the high-speed trading space. We've invested in DCM in New York, which is working on big data, a group out of JP Morgan. And everyone's doing something a little different. And of course, they all are looking for talent, like the people here, and I know Linda's going to get me to get the next class's resumes to those folks. So we're beginning to see, though, with Numerai and with Andreessen Horowitz investing in Quantopian, which also provides data for people to build block boxes, and QuantCube and a few others, a blurring of the lines between venture capital investing and quant investing. And this is one of the key trends that I'm sure you guys are in a good stage to participate in. FinTech is much broader than just the derivatives and the option games, what Warren Buffett used to call the weapons of mass destruction. So one of the lessons I've learned about markets, by the way, and I've learned a few, and I'll give you a few, which is the markets are not a zero-sum game for each transaction. Now, if you look at the time horizon of the investor, and an HFT model is selling a stock to Warren Buffett, the HFT model cares what happens in 50 microseconds. And if that stock goes the wrong way in 50 microseconds, as far as Warren Buffett's concerned, who cares? He's buying it for 10 years. So they may both be right. The stock may go up in 10 years, it may go down in 50 microseconds. Both sides win. It's not a zero-sum game with respect to the parties making the transaction. Maybe in the aggregate of the whole market you can look at it that way, but that's not useful for building models. You have to look at time horizon. So when I look at quant funds, I look a lot at the time horizons they're trading in. So what did Renaissance, the last sort of public things Renaissance said, and it's obviously very secretive, is that what they try to do is predict the 2-day trajectory of every instrument they're looking at. They don't just predict the point, but they predict trajectory. And trajectory is very important, because if I tell you that Bitcoin, which is sort of $1,250 or so when I last looked this morning, is going to be $4,000 at next year's graduation, what do you do? And the answer is not the simple, well, I mortgage the house and I buy all the Bitcoin I can. Because if that goes from 1245 to 300 to 5,000 and back to 4,000, there are a lot of opportunities lost. First of all, you get wiped out if it goes to 300 and you've margined too heavily. Secondly, you miss most of the upside if you do the other way. So in predicting and looking at things, predicting trajectories is almost, in some ways, more important than just predicting the endpoints. The other thing I distinguish is what is the average holding period. So there are great funds that I've invested in that have that I can sleep nicely at night because they're all flat at the end of every day. And those are wonderful, but the capacity is limited. And some of those are HFT. I do much less of that now because that's become an arms race. Some of them predict at the 1 minute level. Some of them predict at the 1 hour level. Some of them predict at the 1 day level. Those have, generally speaking, modest capacity, but are great for feeling good at night and sleeping at night. If you can predict at the week, month level, you can get much bigger capacity. And when you get to the point of what Renaissance did with the Renaissance Institutional Equities Fund, a 30-year time horizon fund, then you can have giant capacity. That fund could have a $100 billion capacity, but you have to be willing to hold for 30 years to get the gains that they promise. Another lesson I have learned, and we do it at First Round, is quantify everything. So one of the things we did at First Round is start collecting data from day one. Josh and I both sort of fanatic about it, on everything we did, on every company we looked at, the founders, what the companies were doing, on how we voted about those companies. So a year and a half ago, we produced our 10-year study, which showed in terms of startups that had a woman co-founder did 62% better than startups that were just all men founders. And startups that had a founder who had graduated from one of the top university programs, we had some definition around that, but you'd qualify, did substantially better than students who didn't have that. Now, that doesn't mean that's all we fund. We fund great people and great ideas. But statistically speaking, there's a lot of correlation to having good background, good intelligence, some training at a existing firm, and diversity in the part of management. Now, the new key trends that we're seeing in a lot of these things are quant models are deep learning and big data. So people have used classifiers for years and keep trying simple classifiers. We're now seeing these real deep black box models. And I worry a little bit about how that's going to turn out because you have to train it on monstrous amounts of data and you have to hope that things stay relatively the same. And one of the key learnings from my career is that the markets are very dynamic. They change all the time. Any advantage gets arbed out, and that's true of the models. So you have to always be learning, and your model has to always be learning, and you have to rerun them either daily or every hour, and that takes huge now amounts of computing power. We're seeing more of that. I mean, everything is so dynamic. That's why did the models get the election wrong, or so many of them got it wrong? Because they couldn't adapt fast enough to other changes that were going on. The final point in terms of points of learning are risk management. So Jim always used to say throughout the 80s when we were working together, he said, it's not a model if I have the ability to stop it or to change it while it's running. It's either a model or it's not. So when you look at a lot of the quant firms that have people sort of monitoring what's going on and they occasionally put their judgment in to override the model, if you override the model, it's not a model. You just got to have a model. The only lever that we do have and that Renaissance has is risk, is how much risk do you want to take today? And at Renaissance, there are people who look at the overall world economic situation, the political situation, and say, we're going to be a lot more volatile. We may want to dial down the risk a little bit. And managing risk is very critical. You've learned about the Kelly criterion, I assume. We saw too many funds get wiped out because they over-leveraged. So managing risk is the one lever, manual lever, that you can put on a true model and still sleep well. The other thing about modeling is accounting for the real-world data. So we used to talk about optimization. I learned about optimization as an OR person. One of my professors said, for most people, optimization means looking optimistically at a problem. The real world always puts snags into those things. Trading costs, slippage. And one of the things that I look very carefully at when somebody shows me a model whose back testing looks wonderful is, what did you assume for fill rate on your orders? Did you assume you're going to get 100% of the orders that this model was generating? 100% of those signals would get executed? Because that ain't the case in real life. And so you have to really start accounting for real life. All right, let me close. Let me say that you guys and girls, women, men and women, are all armed with an amazing education here. You have the tools, you have the ways of thinking about financial engineering, and hopefully you'll use those to do very well for yourselves and then to do good, as Jim has done, giving the MSRI building across the street, and many other things in supporting mathematics and education. I envy you in this program with a 100% placement record, which is really, really something. And I just want to say that going forward, you need to be committed to the organizations that you create, found, or work with. You need to be really committed to them, not just involved. And the difference, between commitment and involvement is like bacon and eggs. The chicken is involved, but the pig is committed. So you have to be really committed. I wish you the greatest success. Go forward and do good in the financial world. Thank you.